My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to save you some money. My job is not just to entertain, but I got to put all this in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Even though I am distinctly not thrilled about the setup here, can I just say that it does not make all that much sense for our stock market to be down as hard as it was today off of weakness in China, even as I've repeatedly said that China is a shadow of its former self. The Dow closed down 361 points. S&P lost 1.16%. Nasdaq tumbled 1.14%. And the primary culprit was not the bond market. Jeez, I heard that all day. It was some incredibly weak Chinese economic data overnight. Now, let me ask you, I'm not ignoring the ongoing collapse of gigantic corporations and trusts in China. But do we really believe China should be super important to our stock market these days when the U.S., frankly, is in ascendance and they're teetering? I think that China's hurting, and it will spill over to other countries for sure, but not as drastically as some would think. A big reason why China's weak is that we were the marginal hiring machine for the country because we depended on them for so many cheap goods. We still, by the way, import tons of stuff from there, but it is flattening out. What's more important is U.S. divestment from China, whether you hate him or love him. President Trump made it a priority to funnel investments away from China while slamming their goods with tariffs. And the Biden administration is actually doubling down by making technology the restricted goods, which might have a far greater impact on the progress in the future. The fact that the Chinese government decided to stop giving out numbers on youth unemployment this morning was jarring. And it may mark the beginning of a blackout of bad numbers, because that's what authoritarian regimes do when business isn't going their way. So again, even as I don't want to ignore the pending collapse of some major important Chinese financial entities and real estate entities, I find it odd that our markets become this hostage to China. Think about it. This morning at 4 a.m., Europe was already trading down off the weakness in China. More reasonable given the quarter of their exports go to the PRC. Then the U.S. market followed suit almost exactly. I have to question that because we don't have that kind of affiliation, and our institutions and consumers are so much stronger than those of Europe or, of course, China. Sure, we do have big companies with lots of exposure. You know what they are: Apple, Starbucks, Nike. But beyond that, not many American companies are going on all cylinders with China. And investors here do own a lot of Chinese stocks and bonds. They do it in a lot of different trusts in a lot of different ways, but not enough to take us down, which is why I think it's so ridiculous to sell our stocks off of Chinese weakness. And I say this as someone who's not super bullish right now. I do think we need to abide by the work of Larry Williams, that great market historian. He came here and told us to counsel, remember the P word, he said patience for the month of August. But man, when it's down like this and the oscillator we follow goes nicely into negative territory, it makes us want to pick at some stocks for the charitable trust, as we did today, small and on the way down, nothing aggressive, because we don't think the sell-off is necessarily done. Now, I don't want to give away any of our moves. They'll be chronicled at our members-only club meeting on Thursday at noon. Club members will be angry at me. But I will say that our MO is always the same in the investing club. We buy stocks of broad, long-lasting themes we know are working for our day-to-day reflections and our homework. May not turn around immediately. But what I think you need to know is you buy thematically, then you can buy bigger on the way down. First theme is infrastructure. Now, we know that our government is spending more than $1 trillion trying to make everything better environmentally while fixing our roads, bridges, and tunnels. I love the infrastructure theme here, China or not. And that's the chief reason why the trust owns Caterpillar, which had a big run down, very big today, though. Same goes for Nucor, the biggest steel company in America, which also has a very thick order book. Sterling Infrastructure, I profiled them last night. They should do quite well with all this infrastructure spend. And then I can say the same thing about Jacobs Solutions and Mastech. Now, don't forget all the money earmarked for clean heating, ventilation, and air conditioning, particularly for our schools, and that means Carrier. I buy these stocks on any China-related dip because they have almost nothing to do with China. The second big theme is aerospace. Incredible trend here. We're seeing such a shortage of planes that anything connected with aerospace should be a winner. Here I'm talking about Boeing, GE, or Honeywell. We bought some Honeywell for the travel trust this morning. And no, I don't believe the tourism boom is over. I think it will remain in place as long as people are long on money and short on time. Common theme of the traveler right now coming out of COVID. Chinese woes will not stop the travel. Third theme, if anyone thinks that our drug companies are connected to China and therefore their stocks are going to get hurt because of China, I think that's frankly insane. I like Amgen because of its breakthrough anti-cholesterol drug, Repatha. By the way, that thing is selling incredibly well from that last quarter. And, of course, I like Eli Lilly because of its incredible diabetes drug, Mounjaro, that I believe will be approved soon for obesity. I bet it could be the greatest selling drug of all time. Fourth, housing isn't stoppable either. I like that Warren Buffett just endorsed Lennar and D.R. Horton. Although he's a bit late, I thought Home Depot's numbers were just fine, thank you. And the stock would have been up even more if China hadn't colored the whole tape today. Remember, they have no stores in China. I do wish Buffett had bought Toll Brothers along with the other home builders because Toll's doing as good or better than the others. And they're the only publicly traded high-end home builder. That makes their product very scarce. The incredible thing about the home builders is that their gross margins keep getting better now the supply chain problems have been solved. The fact that they haven't really been hurt by higher mortgage rates is astonishing, isn't it? More on that later. Fifth theme, I think it's tech that makes the most sense to buy here because it's always been right to buy tech off of Chinese weakness, even when China has been teetering, and we've seen this before many times. Does anybody believe a slowing Chinese economy has any impact on artificial intelligence? China's still desperate to get their hands on NVIDIA chips in order to build their own competing storage, their own competing systems. They want to build supercomputer. You need NVIDIA's chips to build one. And I gave you my wrap on NVIDIA last night. I own it, don't trade it. I'm sure there are plenty of traders in it, though. I don't want you to be one of them because the long-term future of AI depends almost solely on NVIDIA. It's worth owning for the long haul, regardless of what the quarter is. Amazon, Alphabet, Meta aren't even connected with China either. In fact, some of them aren't even allowed to do business there. So they're all good places to go. Amazon had an amazing quarter. I think they'll be the first of many as they rationalize their distribution network post-COVID. Alphabet, I expect to crush it with both the cloud and the NFL Sunday Ticket, which I think people are going to just stream DirecTV from to the stream of, yes, YouTube. Meanwhile, Meta's the best investment out there for advertisers, though Amazon and Alphabet come pretty darn close. Gross margins and earnings leverage, huge. Now, you might say, how do these stocks jive with the Fed, which was the other conflicting theme about why people thought the market was going down? Well, I come back and say these are themes that have been withstanding the Fed pressure and can continue to do so. Now, I know housing seems hostage to interest rates, but it's escaped from the hostage situation in the past year. The home shortage is strong enough to trump almost anything. The economy is cruising. I think the home builders can still rally. I didn't include the financials because they've become too problematic, too much regulatory worry. I didn't include Apple, even though I think it's terrific, simply because I want to own it, not trade it. And I don't think you're necessarily getting the best entry point here because the negative Chinese press isn't going to go away anytime soon. I expect more people to say negative things about China. But the bottom line, if you have some cash ready, as I've repeatedly advised as we've raised cash, it's precisely because of days like today, maybe tomorrow, where the market gets hit on something with little relation to our economy, but is important, and there's no denying that. You can apply your cash lightly here, then buy more as we go lower to these themes, because the situations tend to last for more than a day or two, and the themes last for ages. So be prepared for pain. Just know that
the house of pain.
The pain can be a buying opportunity as long as you know what to buy and can buy slowly, in stages, on the way down, as we do for the trust, and tell you before we do, every day of the week. Rebecca in Florida. Rebecca.
Booyah, Jimmy Chill. And thanks
Booyah,
for all your
Rebecca.
hard work. I was just wondering, with inflation rates continuing to cycle and change, is Target a better buy over Walmart, both in the short-term and long-term perspective?
Okay, so Target reports tomorrow, and one of the things that I've done over that we've been on this show for 18 years is I've stopped playing the game of what's it going to do tomorrow. I think that's a dangerous game. I happen to like the company Target very, very much, and I think that matters, and has a 3.5% yield. But I don't know what it's going to report. There are always these traders in and out. They're going to shoot the stock down. Maybe we take a look at it after they report. We listen to the conference call. How about Trey in Texas? Trey.
Jim, I interviewed for a job today, and when asked to describe my leadership experience, I said I lead a guild of over 300 people on World of Warcraft. The search continues, but I will say this. There aren't many Fortune 500 CEOs who can do what I do. And honestly, delivering for Papa John's probably wasn't a good fit for me anyways. My question is, does the stock fit in my portfolio?
Wow, the 300. I used to think of them as spots. Okay, so long, look, I happen to like Papa John's, but I've got to tell you, I thought the Domino's reported a good quarter, and I think Yum is the slow and steady win the race in the group. Now, if you have some cash ready, as I've repeatedly advised, as I've said, sell and sell and sell and raise cash and raise cash. It's precisely for days like today when the market gets hit on something with little real relation to our economy, even if it is a bad thing. And you know I think China's in a lot of trouble. On Made Money Today, subscribers to the CNBC Investing Club know we've become a fan of oil and natural gas producer Coterra, But after the company reported a good quarter last week, do we need to hear more? Don't miss my exclusive with the company CEO. Then with mortgage rates inching over 7% and home builder sentiment failing, what should you make of a company that should be right in the crosshairs of the bears, builders for a source? I'm building a case for the stock and sharing what you need to know. Norfolk Southern wasn't initially hit after reporting a top and bottom line miss, but boy, falling 12 of the 14 last trading sessions? What the heck is going on here? I'm digging into stories with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.